Hi, everyone. Welcome to the Canadian Passive Investing Show. I'm your host, 𝗖𝗽𝗶𝘁 𝗖𝗽, and I'm joined by my co-host, 𝗖𝗍 Biniaz. We have another great show for you today. Please like and subscribe as it helps us build our channel and allows us to keep bringing you great content and expert guest speakers. Our mission is to empower investors to earn passive income through real estate investing. Really excited. Today, we're joined by Anthony Scandariato. Anthony is a real estate entrepreneur and multifamily investor with a focus on in-place cash flow and forced value-add appreciation. He is strongly passionate about helping people leave their 9-to-5 with passive income through multifamily real estate investing. He's also the co-founder of Red Knight Properties. Red Knight Properties is a privately held boutique multifamily and mixed-use real estate investment and property management company with a track record of building and managing portfolios that deliver dependable cash flow and equity upside, what we all want more of. Anthony is also the host of the popular podcast, which we spoke on, Discovering Multifamily, and also teaches others how to become financially free through multifamily investing. So 𝗖𝗍 and I believe that this interview with Anthony is going to bring, great value to both investors looking at the multifamily asset class as an investment, but also believe that this interview will bring value to active investors that are looking to scale their business. So welcome, Anthony. Thank you so much.
Welcome, Anthony.
Great. Thank you, 𝗖𝗍 and 𝗖𝗍, so much for having me on your show. We had both of them on my show, as 𝗖𝗍 mentioned, Discovering Multifamily. Check out that episode. It was released on July 21st. Of season 1, episode 149. So you guys just missed the 150 mark, but we had a great time discussing Canadian passive investing on there. So check that out. And I'm more than thrilled to be on their show today. Thanks for having me on, the both of you.
We had a great conversation with you then, and now we're going to have another great conversation now. So why don't we start off by you telling us a bit about your background and in your start in real estate, please?
Great. Well, you did a much better job than I could of introducing me. So you pretty much have it covered. I don't need to do anything. I can sit back now. No, with all kidding aside, my name is Anthony Scandariato. And as 𝗍𝗍 mentioned, I'm the co-founder of Red Knight Properties, which I like to call we're a boutique, middle market, value-add, multifamily, real estate investment, and property management company. So not only do we have the investment side, but we also have in-house property management, construction, and basically vertically integrated a lot of real estate processes into one. So at this point, we have about 625 units, and we're recording this towards the tail end of 2021. So, we've been growing, and, as I think 𝗖𝗍 mentioned, we're going to discuss kind of, my experience or just experiences in general and how I got to where I'm at. And that was, basically over a period of time. So I didn't just all of a sudden buy 600 units by myself or with a couple partners. It was gradual over a period of time. So I'm more than happy to share with you and your audience my story. You just tell me where to start.
Yeah, for sure. You know what? Why don't we tell us about what was it about multifamily that interested you and this strong asset class, I guess, that you now have 600 and some doors in?
Absolutely.
Yeah. So it's, at least in my experience, one of the best, if not historically best performing real estate asset class that I'm aware of. There's other asset classes like self-storage, hasn't been around as long as multifamily apartments that are very safe as well. And there's some other, ones we can throw out as well. But I really love I wouldn't say simplicity, but everybody needs a place to live. And there's a lot of demand drivers, and we invest in the United States. And, there's, a lack of supply for affordable housing in the country in general. And this has been going on for, about a decade now, but it's only getting worse into, 2022, as it's going to be coming up in a few months. So I just saw that as a very large opportunity to take advantage of, older existing apartment buildings that haven't really been touched in neighborhoods that really need investment and capital enforcement. So, we're able to target different markets. We're in 4 different states in the US right now, up and down basically the East Coast. And we've targeted a few, macro markets and some markets that we really like that I would consider secondary. to, basically improve communities and at the same time, obviously make money for us and our investors. So it really serves a mission on a bunch of different fronts. But I really love the asset class, and we specialize in garden style. We like to, I don't like to talk about really classes too much, but I would say in terms of class, it's class C, but we always try to bring it up to class C plus, B minus, take it a step up from where it was currently at. But everybody needs a place to live, and the simplicity of the asset class straight from the beginning just really enticed me. And I have had experience before of starting Red Knight working for another real estate sponsor who bought we bought over, I want to say, 3 million square feet of Class A multi-tenant office buildings up and down the East Coast as well. And office, especially now with the work from home situation, was very challenging even before COVID hit. So I saw that, and I was exposed to some other asset classes that people would consider risky: hotels, retail, and there was a lot of challenges every day. Not saying multifamily doesn't have its challenges, because it sure does. Especially with COVID, you couldn't evict anybody for a very long period of time, and we were struggling with that. But just historically speaking, in recessions and downturns, the workforce housing, what I like to call it, segment, is where we have been playing in, and we really like the asset class and want to continue to grow.
Great. Just to touch on the asset class in particular itself, and you were talking about the different levels within the particular multifamily asset class, the C class. There is an asset class. It's like the metric or the number, the class of the class, or however you could say it, is the level of the asset class. The C class is on the structure itself, but the neighborhoods also have an asset class for a neighborhood. So talk to us about that. And when you're going to purchase let's say a C minus asset class of the structure, it would probably make sense to purchase that in a C plus neighborhood or a B neighborhood. So then when you do bring it up to market, you can then ask for the rents that make sense in that neighborhood. Talk to us about that aspect.
Yeah. Ideally, in an A neighborhood, buying a C in an A neighborhood, that comes as well. Where we specialize is we're mostly in suburban areas. So we have a little bit of what I like to call infill locations as well, within an hour of a major metropolitan area or central business district. So we're not generally considered Class A areas to begin with, because we're outside of the core metros. So we're generally in B, like you said, August, B areas, and we're buying C product that we can elevate. And that's just also going to elevate the neighborhood as well. But the number one thing that we look at, and all smart real estate investors should look at, are where are the jobs, how many, where are the demand drivers, what industries are there? Is it concentrated? Is the market concentrated by one industry or a diverse, amount of industries? Are there any new jobs and employers coming in? So we look at that more so, in order to make a determination on if it's an A area or B area, et cetera. So we like to go where the path of progress is, and not where it currently is.
Fantastic. Thank you for explaining that.
For sure.
And go ahead.
Sorry, just want to follow up on a question before I lose track of my thought. But you as you mentioned, Red Knight Properties, you're a vertically integrated company, so you have a property management division within the company as well, and that's key. So in my research initially, when for CPI, when we were cultivating a relationship with investors, we were also looking at institutional investors like family offices. And what we realized early on was that when institutional investors are looking to invest with a sponsor, with a real estate sponsor for value-add project, when they're looking to invest with them, one of the items to look for is for that company to be vertically integrated and have a property management in-house. So it's incredible what you've done. But talk to us about that experience, because it's hard enough and complex enough to manage a real estate investing firm, but now to also have a property management firm. And then how do you manage it within multiple states? Do you have a certain manager that looks after certain employees that come on board? Do you use subcontractors? Talk to us about more, how is that dynamic?
Nice.
Yeah, no, it's a great question, because a lot of real estate sponsors that I encounter as well, where they're located, they'll have their property management team. But if they invest out of state, they won't property manage. And there's no really right or wrong answer to your question. It's really dependent upon what is the, I guess, motivation behind it from the sponsor's end. And my motivation is to have, more control over our asset and to be able to handle things that come up in-house and not rely on a third party, even if they have a great reputation. And it also comes from, a learning experience that I think every real estate sponsor should have, because the more involved you are with property management, and obviously if you're running a real estate company, you can't be involved with everything. You're just not going to have the time. But for when you can have the time and, for the ability to learn from people you hire, whether they're on the ground or virtual, is invaluable, because it's only going to help you grow your business even further, as you're going to need to know what to look for. If you hired a manager and let's say they're not working out, now you need to know what you need to look for in a new manager. So there's many benefits to doing it in-house. Yes, it is a pain in the ass to manage, and I'd say it's harder than even the investor relations, even the capital raising, sometimes even finding deals. It's a very challenging part of the business, and that's why a lot of operators don't do it. So for us, it's challenging. It does take time, but to answer the latter part of your question in terms of the systems and teams we have, we're in 4 different states right now, and we have basically a maintenance technician in each state, and each property we have is geographically located within maybe 20-30 minutes of each other. So we'll have, let's say, 4 maintenance technicians, and then we do a hybrid approach. I don't have any leasing people on my staff, but we do outsource the leasing to a third-party brokerage like a RE/MAX or eXp Realty. So they help us with the leasing of portfolio, and then I have a maintenance person on my staff who's responsible for, basically, sometimes they're responsible for renovations, but we have contractors for that. Obviously repairs that come up that should be handled in-house, toilets and other things that are minor that come up. So they're in each state at each location, and I have a senior property manager on my staff, and I have a bookkeeper on my staff, and we outsource some tax return work and a couple of other things. So I wouldn't say we're fully integrated, but we're pretty close. And it just comes with scale, because it's tough to, manage smaller amounts of units and think to yourself, is this really worth my time? This is taking up so much time. Well, on the management side, let me just outsource it so I can buy more deals and grow. That's a great mentality to have. For me, it was more of, let's really execute on our business plan for ourselves and our investors. Let's really have full control. Let's learn a lot from it, because maybe at some point, as I'm saying this now, property management, it is a pain in the ass. We might want to get rid of that division or sell it off to another, whether it's a smaller private equity company or, real estate company. We might want, there's options into having your own property management company. It does come with the headaches for sure. But even if you hire a third-party manager, you're still going to be managing the manager. So, you kind of are removing a layer, but at the same time, you're not. I've had experience with both. So there's not one right answer for the question, but I do think it's been beneficial to us, and I don't think we would be able to hit the same returns we would have hit without having it in-house.
Of course, because you're hands-on. It's your team looking at the property. Anything that happens there, they're relaying that information to you. So that's truly great.
Yeah, that's really wonderful. You got to do what works best for you. Sure. Anthony, maybe you could tell us a bit more about Red Knight Properties. We talked about the type of asset class that you guys focus on. How do you guys do you raise private equity for these investments? Maybe you could talk to us a little bit about that, please.
Sure. Yeah. So in terms of private equity, we don't traditionally go to, the private equity firms, or although we've been approached by family offices, et cetera. We really, as you said in the beginning, Ava, I'm really focused on helping people escape their 9-to-5 through real estate investments. And so are the both of you. So I have professionals from all different industries that are investing with our company into our real estate deals. So I have people in the insurance, world investing with us. I have people in brokerage that are investing with us. I have people in the medical field that are investing with us because they don't want to do their profession forever. There's some, end point in their profession, and they want to have passive income streams. And a lot of my investors are younger as well. So starting out in their 20s and 30s is really great because they really get to see their net worth explode, through real estate investments and cash flow position increase. So my, partnership with the group that I formed are really just individuals that are, the accredited investors for the most part, and, have a nice high paying W-2 job and have, investments in the stock market and, in other mutual funds or any other financial product, but they don't want to be 100% in the market, and they want some diversification. So that is our, investor pool, I would say. And to answer your question on the capital raising, most of the people actually all the people in our transactions are people that we know personally, or we've gotten to know them through referrals. And, we like to sleep at night too. And, having people you don't really know and you're involved in your business is doesn't sit right with me. We have a list of about, 300 investors, but maybe we have active 75 to 80 investors, but I literally know all of them personally. And I don't get headaches. I don't get people calling me at 2 o'clock in the morning. It's streamlined. And back to your point, August, of getting systems in place, it's always, especially if you're having that many investors, it's good to have that. And you want to be SEC compliant with all the deals that you do as well. So we got to make sure you have good counsel for that. It's building that whole team, but it takes some time.
Yeah,
and it took me a while to build this up as well.
And yes. I wanted to maybe talk to Anthony about the process of cultivating and nurturing like these 300 people that you have in your database and the active, 75 to 80 active investors. How do you nurture these relationships, especially when you first started out in the business?
Yeah, so when we first started out and we bought our first couple of deals, I still do this. We send monthly deal updates and quarterly financial with the distributions as well. So most sponsors don't do that. They don't send monthly deal updates. Maybe they'll send it every quarter, and with the distribution, this is what's going on in the property, et cetera, et cetera, et cetera. I had one partner who's in a newer deal of mine who she actually the sponsor just sold the property, and she didn't know it was selling until a month before it happened. And she's like, well, I didn't even have time to tax plan or do anything, even though these are limited partners and they need, they're relying on the general partner to do what's best for, their interest. I don't know. I find that strange. They should be communicating more often. If I gave my money to a sponsor, or if I was in something else, I don't know. I'm not going to hit them up every month or anything, but it would be nice to just know what's going on, even if it's bad, or there's some situation that came up and you have a creative solution to mitigate that. I can't tell you how many people respond to my emails or, my company emails with my partner with like, yeah, we really appreciate this. This is like super detailed. It takes a while for us to put it together, but like we really trust you guys now. And, your next deal I'm in, like, just let me know. And these are like new investors too, first timers. Mm-hmm. So I think the nurturing, for the active investors, it comes along with just your performance. In terms of new investors and getting them on board, they usually get on board, like I said, it's mostly through referrals and social media as well. You guys have a great platform that you consistently deliver great content on and post, and you keep coming up and you're creating a brand for yourselves. So we tried to do the same thing as well when they think of multifamily real estate. We had the podcast. I started that, and that's been very beneficial to interview guests like yourselves that have experience and have been in the game. And it's always a good, conversation. And a lot of my partners listen to it as well. So they get familiar with my voice, with my, train of thought and my, my company, and just kind of, they probably listen to me more than I listen to me. So,
yeah, that's really Discovering Multifamily is your podcast. How did it all come about when you started your podcast and so forth?
Yeah, I mean, I've always wanted to do it, and when COVID hit here in the States in what is it, March or April last year, I just said let's put something together, and I really wanted to do it for the learning and educational aspect of just teaching people more about real estate without any strings attached. I just recording a conversation between me and high-level individuals in the industry or some outside of the industry as well, just to learn what strategies they were implementing in their business. And they're mostly multifamily investors, whether they're active or passive. So it's good to have different perspectives, and a lot of good people like yourselves that I've met as well through that platform. It's great to have. But the nurturing aspect is just as important as the prospecting aspect of your capital raising side of your business as well.
Yes.
Yeah.
Yes. And talking about this, continuing this topic about that relationship that exists between the general partner and the limited partner, the name is right on it. It's partner. It is a partnership. So you're talking about, getting a good night's sleep is, we are going into partnership, and sometimes groups, especially with joint ventures prior to, looking at private equity or looking to, bring on passive investors onto a real estate project. Most investors start with joint venturing. When you joint venture with someone, you're literally married to them. It's also the similar thing when it comes to the world of real estate private equity and these syndicated investments. There is a partnership in place, so there needs to be a comfort level, there needs to be trust. And just to add on that is a lot of times passive investors is becoming fashionable to be passive investors. Some people are professional passive investors these days. They make a great income, but now they're there looking at these different groups to invest with, and it's like literally like teams. And hey, who's their quarterback? I want to invest with this team, or I want to partner with that team. So it's great, and a lot of times the decision is made on the principle. So this is my personal view, but I really enjoy talking with Anthony. I really enjoy him as a person. He just clicks with me. So as an investor, it's not really about the deal he presents, it's about that relationship. And it's also about how easy is the person accessible. A lot of these companies, you don't even get to talk to the CEO. The company is so large, the large REITs or these large funds, you don't even get to talk to the person. But when someone like Anthony makes themselves available, is putting the time in, has a podcast, has the communication, and just that creates that comfort level. Is like, hey, listen, you could invest. When you're partnering with a general partner, you could invest in a great opportunity. But if you don't get along with a general partner, or the general partner doesn't do the job properly, the deal might not go well. And you could invest in a not so much great deal, but if you have a general partner that does the job well, the deal would prosper. So
investing in the person.
Yeah, I definitely like, if there are any, sure there are, if there are passive investors watching the show, is get to know the general partner. If you feel like it's a long process to getting on a call, or even the chance of booking a call, and then see how you like the person. Hey, if something goes wrong with a deal, is this person gonna genuinely take care of me and be there, take care of the investment? So just want to kind of touch on that, since we were on topic of the general partner.
No, for sure. You're investing in the person, and Anthony, you're a great person. So
thank you. No, so are the both of you. And just to touch on that a little bit more, it's especially if you're a passive investor looking to invest in real estate with a sponsor, what we offer on our website, 𝗖𝗽𝗶𝗁 and I believe you have a section on it as well, is frequently asked questions for a passive investor to ask the general partner, because you are really relying on the general partner, especially if you're a doctor. You really don't. That's your profession. We're not expecting you to know what preferred returns are or what a promote split is. That's our job to educate. So I provide, on mine, at least a list of, okay, here's a few things you should look out for when you talk to your, potential sponsor looking to invest with. I believe you have some resources too. So I want to just say that as well. Just because I think that's important. And I have a lot of investors that call and they don't really know what to ask. They're just like, tell me about your platform, which is fine too. And obviously that comes with a trust and comfort level. It depends on the investor and the level of financial sophistication, so to speak, in deals as well.
Absolutely. The track record helps as well. We recently saw you made a post about a refinance that you did on one of your projects. Yes. Talk to us about that process when you get to go through the whole cycle with a deal and sending out distributions, refinancing deals. Talk to us about potentially getting investors to reinvest in other deals you have.
Yeah, no, definitely. And the refinance is almost full cycle, but it'll
Yes.
it's a return of capital event, so which is great. And that's what happened. It was 100% return of capital so if someone gave us $100,000, they got $100,000 back 14 months later, plus their preferred return for that entire year that we had the investment.
Amazing.
And now moving forward, there's a split in the cash flows, but they will still be receiving distributions as well as we will as well based upon our performance. So really excited about that one. And I think I failed to mention before is most of the structures, we have some, you mentioned joint ventures, August, we have some joint ventures. That's how I initially started out. I had a joint venture with myself and my business partner, Brian, who we still have properties that we own, just the two of us together in a joint venture. And then from there, we haven't bought a personal property in maybe 2 years now on our own from, because there's only a certain dollar value you can buy by yourself with somebody else, in your own money. That's why we like the syndication aspect, because we can buy larger opportunities and have a nice group of people who want to buy in together to a larger deal. So I just want to say that most of the deals are syndications moving forward. There is always the one-off, but we do prefer this model now instead. So yeah, and the refinance is great because everybody gets their return of capital. Yeah, there's going to be a little bit less cash flow moving forward. Maybe not. It depends upon what kind of terms you get from your lender. But what we try to do is, if there is a return of capital event, most of the times, our investors will get their initial capital back, and wow, you just gave me back $100,000. I don't know what to do with it. You got anything else? So that happens like 90% of the time when this happens. So we do try to line up another project that they have the ability. We don't hold the money back. I know sponsors who hold money back too, which I don't think that's the right thing to do. We literally give it back, and then we say, hey, here's your 100 back. Here's another opportunity. If you want in, great. If not, no big deal. Take your 100, or even take half of it if you want to come in. But you're not obligated at all. I know some sponsors are a little different, which I don't understand. But that's the way that we want to run our business.
Believe us, we know when other sponsors and the different things they do, many products here in Canada offer considerably less returns and almost no preferred returns that are available. So we know exactly what you're talking about. Kind of, we give our head a shake as well. So great. So now that was wonderful. Now come to the fun part of our show. We've been having a lot of fun.
Oh, it wasn't fun already?
But the exciting part of the show.
Exciting part of the show. Okay. 10 championship rounds to financial freedom. So I'm going to go ahead, Anthony. Here we go. Just whatever comes top of mind. Who was the most influential person in your life?
My father, for sure.
Okay, awesome. What is the #1 book you'd recommend?
There's a few that I like. I really like The Miracle Morning. That was, it's not necessarily a real estate book. Everybody says Rich Dad, Poor Dad, so I don't want to be common with that. But Miracle Morning really, really changed my life.
Okay, nice. If you had the opportunity to travel back in time, what advice would you give your younger self?
Start investing in real estate earlier.
Nice. What's the best? Yes, absolutely. What's the best investment you've ever made?
Well, there's a few that I really liked, but our first, it's weird because people say the first deal you do isn't the best, but the first property I've ever bought was a 2-family house, and I still own it myself. And just from the cash flow, I got my down payment out in like 15 months. Wow. It's crazy. So that's my favorite, but there are a few more that have obviously come up.
For sure. There. What's the worst investment you've ever made?
Worst investment I made, I haven't really had too many bad ones, to be honest with you. There's ones I've been more disappointed with on the cash flow because some deferred maintenance I didn't expect had came up. There was a smaller 12-unit property in New York State that we bought in 2019. Actually, the return is really good, but I think we're going to sell it just because it's getting old.
Nice. Okay. Now, how much would you need in the bank to retire today? What is your number?
I don't even think about that.
Nice.
I'm young. I'm not trying to retire anytime soon.
There you go. There you go. Love it. If you could have dinner with someone dead or alive, who would it be?
Dead or alive? I would love to meet Warren Buffett, obviously, and he's still alive. Hopefully, he's got many years left. He would be my number one.
That's awesome. Now, if you weren't doing what you're doing today, what would you be doing now?
I wasn't doing. That's a good question. I would be. I don't know. Maybe in a different. I can't see myself doing anything else. So I
You
don't know.
love what you're doing. You love what you're doing. I
Yeah.
love that. Book smarts or street smarts?
Streets.
Okay. And last question. If you had $1 million cash and you had to make one investment today, what would it be?
Multifamily property.
Yay!
So,
Awesome.
Good
That was
answer.
great. That was great.
And that's a wrap. Anthony, what's the best way that people can reach you?
sure. I mentioned the website is my website, 𝗖𝗽𝗶𝘁.com. We actually have a free ebook we're giving out. It's called How to Achieve Financial Independence by Escaping Your 9 to 5. Actually, if you download that, you'll get a personal email from me, and feel free to schedule a call with me on there. And obviously, we have LinkedIn, Facebook, Twitter, Instagram, you name it.
Amazing.
Amazing.
Thank you so much for coming on our show, Anthony. You're great.
Thank you, Anthony, for coming.
You both are great. Thank you.